Welcome to The Explainer. Today, we're going to tackle a pretty huge question. How is it that some of the wealthiest people out there can legally pay so little in taxes? Let's get right into it.
You've probably seen the headlines, right? Or maybe you've heard guys like Robert Kiyosaki or even Donald Trump openly talking about paying little to no tax. And it's pretty natural to hear that and think, wait a second, how is that not illegal?
And that really is the million-dollar or, maybe billion-dollar question. How can one person go to jail for not paying their taxes while someone else seems to do it legally and is totally open about it? It feels like a total paradox, but there's actually a very clear answer.
The key to this whole mystery comes down to one thing: understanding that there isn't just one way to lower your tax bill. There are actually two completely different paths you can take. And, well, they lead to very different places. One might lead to a bigger bank account, and the other could lead to prison.
And here they are, side by side. On the one hand, you've got tax evasion. This is flat out illegal. It's all about hiding money, deception, and straight up lying. But on the other hand, you have tax avoidance. Now, this is the legal art of using the existing, complicated rules of the tax code to your own advantage. So let's break down what each of these actually looks like.
First up, let's talk about the dark side, tax evasion. This is the stuff that gets people into really serious trouble with the IRS. It's not about being clever, it's about committing fraud.
The simplest and most common way people commit tax evasion is by just lying about how much money they actually made. I mean, it makes sense, right? If the government doesn't know you earned the money, they can't tax you on it. Of course, they have their ways of finding out.
So, just imagine this scenario. John sells a house to Bob. The actual price is $700,000, but on all the official paperwork, they write down $500,000. Bob just pays the other $200,000 under the table. By hiding that $200,000, they've just illegally dodged a bunch of taxes. That's a classic case of tax fraud. Okay, the next illegal trick is a little more sophisticated, but the basic idea is exactly the same. Hide your money where the tax man can't see it.
For decades, Switzerland was famous for this kind of thing. An American, we'll call him Tom, could earn his money in the US and then secretly wire it to a Swiss bank account. Because of Switzerland's super strict privacy laws, the IRS would have no idea. But this has gotten way harder to do. International agreements now basically force banks to share information, so trying this today is a really good way to get caught.
And the third major way people try to evade taxes is by lying about their expenses. Businesses are allowed to deduct legitimate expenses from their income to lower their tax bill. But the key word there is legitimate. So let's say Sarah has a pizza place. She does a little renovation that actually costs $3,000. But then she gets a fake invoice created that says she spent $30,000. She then reports that phony $30,000 expense to the IRS. By doing that, she's illegally lowered her taxable profit by an extra $27,000. It's just lying to save money on taxes, and that's a crime.
Okay, so let's shift gears from all the illegal stuff and look at the other side of the coin, tax avoidance. Now, this isn't about breaking the law, it's about using the complexities of the law itself. Think of it less like cheating the game and more like playing it with a really advanced rulebook.
One of the most powerful strategies, especially for these giant multinational corporations, is setting up smaller companies or subsidiaries in countries that have crazy low or even zero corporate tax rates. We often call these places tax havens.
This is just a brilliant and at the time perfectly legal move. Apple set up a subsidiary that was incorporated in Ireland, but get this, it was managed from the US. Because of a weird difference in how the two countries define tax residency, the US looked at it and said, hey, you're an Irish company, we won't tax you. And then Ireland said, well, you're managed from the US, so we won't tax you either. The result, they created a company that was basically stateless for tax purposes.
And this really shows you the kind of scale we're talking about. Using strategies just like that, Apple was able to legally avoid paying an estimated $44 billion in taxes over just 3 years. This wasn't illegal, it was just very clever financial engineering.
Another really powerful technique is called transfer pricing. This is basically a clever way for a company to move its profits, at least on paper, from a country where taxes are high to one where they're low or even non-existent.
So here's how it works. A US shoe company sets up a little shell company in the Cayman Islands, where the corporate tax rate is 0.
It then sells its own brand patents to this shell company that it owns. Now the U.S. company makes $1 million in profit, but then it pays this massive $800,000 licensing fee back to its own company in the Caymans. And just like that, the profit in the U.S. is only $200,000, and most of the money is sitting totally untaxed in the Cayman Islands.
Now, this last big strategy doesn't even require setting up companies in other countries. It's all about structuring your income so that the money you make gets taxed at a much lower rate than what a typical salary gets taxed at. This is the famous Warren Buffett example. His secretary earns a salary, right? And that's taxed as ordinary income at a rate that could be, say, 24% or even higher. But Buffett's income mostly comes from things like dividends and long-term capital gains on all his investments. And by law, that kind of income is taxed at a much lower rate, something like 15%. So even though he earns billions of dollars, his actual tax rate can be lower than his secretary's.
So let's try to bring all this together. We've seen the criminal world of evasion and the really complex but legal world of avoidance. But there are a couple of key distinctions that we really need to lock in.
The most important thing is this. Evasion is about breaking the rules of the game. It's like hiding the ball or lying about the score. Avoidance is about knowing the rule book so incredibly well that you can use its own rules to win. One is a crime, the other is a strategy.
And finally, it's really important not to get tax avoidance mixed up with tax deferral. When you put money into a 401k or an IRA, you're not avoiding tax, you're just deferring it. You're kicking the can down the road. You still have to pay it eventually, when you retire. It's about delaying the tax, not eliminating it.
And all of this leaves us with the final, biggest question of all. These avoidance strategies, they might be perfectly legal, crafted by the smartest accountants and lawyers on the planet. But it really forces us to ask, is a tax system that allows these kinds of things to happen truly fair? And what, if anything, should we be doing about it? That's something for all of us to think about.